And the end of the year is fast upon us. You got all the holidays coming up, so it's easy to get distracted, right? And one of the things, if you get too distracted, you may miss taking out your full amount of your required minimum distribution. That becomes a big uh-oh moment because there's a significant penalty that still applies if you do not take your required minimum distribution. Now, the only good news about this penalty is that it's not as high as it once was. It used to be 50% penalty on the amount that you should have taken out but didn't. The good news is it's now down to 25%. So a little bit better, but still that's expensive. Plus remember, because this is a required minimum distribution from a retirement account, guess what? You got to also pay taxes on that as well. So a lot to contend with when we think about the required minimum distribution. So certainly it's important to understand this and to understand, kind of how it all relates, why it matters, and sort of what the requirements are that involve the required minimum distribution. And then we're also going to talk about some of the strategies to sort of help manage the taxes as well. So for those of you who don't know, required minimum distribution is a minimum amount, as the name suggests, that you must withdraw every single year from certain retirement accounts once you reach a specified age. So whether that's an IRA or 401k or similar types of retirement plans, you've got a required minimum distribution. You also have a required minimum distribution if you inherited one of those types of accounts as well. The goal of why there is a required minimum distribution is the notion that that money that is in that account has been sitting there, never having paid any taxes, all of the growth happening on a tax-deferred basis, and the folks in Washington, well, they need your money. So the required minimum distribution rule was intended to sort of force people to take money out of those accounts, and when they do that, then voila, you have to report and pay taxes on that. Now, as we mentioned at the top of the segment, pretty steep penalties if you don't do it, which is why we're talking about it on the program. Make sure you don't get lost in the holidays and forget your required minimum distribution, because that is pretty significant in terms of now that 25% penalty plus taxes as well. Now, the reality is that we see a lot of concern or a lot of fear about the required minimum distribution and its impact. Let me get this on the table right now. For the vast majority of people that are retired, vast meaning well in excess of 80-85%, you're satisfying your required minimum distribution by virtue of the fact that if you're retired and taking income out of your portfolio, then you're probably covering your required minimum distribution, because the required minimum distribution isn't some giant amount of what you have to take of your account. It typically works out in terms of the math to be about 3.65%. That's kind of like the percentage that it starts out. So if you're following kind of the general rule of, I'm taking out 4% from my accounts or 5% from my retirement accounts, and that's generating the monthly income that I need in retirement, well then congratulations. You don't have anything to worry about. You're taking out enough to cover it. Far too often we see these conversations that are really intended to generate a lot of fear that you're somehow missing something or not doing enough. The reality is that for most people, you will find that they are satisfying their required minimum distribution just by virtue of being retired and taking money out of their investments at the end of the day. Now, certainly the age, and I guess this is where another part of the confusion comes into play, certainly the age has changed. It used to be 70 and a half when you had to start to take that required minimum distribution. The first Secure Act changed that to age 72. The most recent Secure 2.0, which was enacted in 2022, increased that age to 73. And in fact, if you were born 1960 or later, your required minimum distribution age is in fact 75. So definitely have had some change in the years. The calculation pretty straightforward. You take the balance at the beginning of the year, divide it by your life expectancy factor that the IRS gives you in the tables, and poof, you've got your required minimum distribution. Now, the reality is that there is tax liability. So this is what we wanted to spend kind of some time on talking through with you all on the program. So one of the things that you can do to offset that tax liability is, because this is a distribution out of a retirement account, what that means is you can usually ask for a certain amount of tax withholding. So you get to have taxes withheld directly from that distribution. So let's say your required minimum distribution is $10,000. You could say, well, you know what, I want 15% withheld for taxes. And then what happens is that when you do that, $1,500 goes off to the IRS. You wind up with $8,500 deposited into your checking account. And so that helps to offset the tax liability of that required minimum distribution. And that's something that you probably want to do, because the reality is this thing is in fact taxable. So, but again, to really dial it in, you want to review your overall tax situation and make sure that, wait a minute, I'm having to pay taxes at 22%, or I'm having to pay taxes at 12%. Obviously, there's a big difference in those numbers. So if it's a $10,000 distribution, you could be $1,000 short in terms of the taxes, and then have to deal with that come April. So make sure you correlate the amount of tax withholding that you're doing to what your actual tax situation looks like. So that's kind of number one. Number two, if you are at all charitable minded, and we cannot stress this enough, the qualified charitable distribution route is a phenomenal way to go that ultimately allows you to make the payments directly to the charity. You can't take the money and then write the check to the charity. You got to have it go directly to the charity from your IRA. But what that does is that immediately reduces the taxable amount of that required minimum distribution. So let's go back to that $10,000 example. Let's say every year you give a couple $100 to your church every month. And so you say, well, that's $2,400. I'm going to do that all in one shot. So sort of fund the entire year. And that's going to be $2,400. If you do that as a qualified charitable distribution from your IRA, then voila, you've only got $7,600 of that $10,000 that you would need to report on your tax return. So pretty powerful and valuable. You can actually donate up to $108,000 in a single year, and every year that number goes up a little bit in terms of these qualified charitable distributions. It is not actually, to do a qualified charitable distribution, you don't have to be required minimum distribution age. You can, in fact, do that anytime after turning age 70 and a half. So that one still has the old age rule under the required minimum distribution. Lastly, you hear a lot about Roth conversions as a way to avoid your required minimum distribution. That seems to be all the rage these days. Look, the reality is that when you do a Roth conversion, you're gonna proactively pay a bunch of taxes, and that's fine depending upon what tax bracket you are in, but far too often that extra income winds up having a significant ripple on your tax return. It could make your Social Security more taxable. It could make you subject to a higher amount of premium that you need to pay for Medicare. So don't just jump into the Roth conversion pond thinking that that's somehow going to solve your required minimum distribution. The reality is, as we said, for most people, if you're taking normal income out, you're kind of solving it anyway. So why bother to pay in a bunch of extra taxes with a Roth conversion if you're already kind of tackling it anyway? Anyway, we're going to wrap it on up and take a break. We'll continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning.